Well, it's been another busy and productive half year with pleasing results. We focused on delivering attractive, risk-adjusted returns to shareholders and value for money. Our cost ratio is one of the lowest of the UK REITs and is reduced as the company has grown. And this growth has delivered increased diversification. Our sector remains incredibly healthy, and we are well positioned to deliver attractive dividend growth from healthy income growth underpinned by rising rents. Exercising patience and strong capital discipline, we acquired 4 assets during the period for a combined investment price of just over £221 million, reflecting an average initial issue yield of 5.1% and benefiting from an average unexpired lease term of 23 years. Demonstrating that we've bought well, these 4 assets have already benefited from a valuation increase of over 7.5% compared to the aggregate purchase prices. 3 of these newly acquired assets were forward-funded pre-let developments. By developing buildings only on a pre-let basis, we aim to add high-quality investments to the portfolio over the coming years at an attractive yield on cost. We also made progress with our 114 acres of strategic land at Littlebrook, Dartford, a London-focused site located inside the M25. Together with our joint venture development partner, we have invested in the demolition and the site preparation of the Phase 1 land, and we are currently on budget and on time with that project. At the period end, the group owned 50 well-diversified income-producing assets extending to over 23 million square feet and 1 development site capable of delivering over 1.5 million square feet. Including capital commitments, our portfolio assets were valued at £2.9 billion. Our portfolio remains 100% let and enjoys a long, weighted average unexpired lease term of approximately 14 years. Like-for-like value growth in our portfolio was just short of 2% for the 6 months. During the period, we concluded 6 rent reviews, adding over £500,000 to our rents. We also successfully implemented our original business plan at Trafford Park, Manchester. We purchased this asset off an attractive yield in March 2018 with an unexpired lease term of under 2 years, and earlier this year extended the lease by a term of 10 years and increased the rent roll by 20%, thereby converting the asset from a categorisation of value add to foundation and delivering strong value growth for our shareholders.
The first half of the year has been another that has seen strong financial performance for the group. Our earnings growth was particularly strong and increased by 5.3% over the 6-month period, resulting in an adjusted earnings per share of 3.38 pence. This grew as a result of 221 million of further capital deployed in the period, as well as 2.2% like-for-like growth across the 6 rent reviews settled in the period. This earnings growth supports an increase in our dividends declared for the period of 3.35 pence, which is up by 4.7% versus 2017. And therefore, we are halfway to achieving our 2018 dividend target of 6.7 pence per share for the full year. Our EPRA NAV per share at the end of June 2018 was 146.22 pence, representing a 2.8% increase across the 6 months from December. On a like-for-like basis, values increased by 1.93% over the 6 months, but more particularly, we achieved strong valuation growth on the assets acquired during the period. Following our refinancing in December 2017, the group benefits from a robust capital structure which is scalable and flexible. At the period end, we had an average debt maturity of 8.4 years and no refinancing events until December 2022 at the earliest. And 62% of our debt commitments remain fixed term arrangements. And we had an attractive running cost of debt of 2.44% at the period end. And when taking into account our interest rate derivatives, our capped cost of debt is 2.66%. Following our equity raise in April of this year, our loan to value has fallen to 25% at the period end. However, when taking into account the capital commitments we have under forward funding arrangements, plus our post-balance sheet acquisition in Darlington, our loan to value would increase to 31% over time. We therefore have further capacity within our leverage target of up to 40%.
Following the period end, we acquired a further pre-let forward-funded development for £120.7 million. This is pre-leased to Amazon for 20 years and is at Darlington. This sees the proceeds from our spring 2017 equity raise fully committed and invested on a geared basis. In April this year, we undertook a further equity raise, which was heavily oversubscribed, and we raised the maximum gross proceeds of £155 million. Currently, we have assets of close to £160 million under offer, in exclusivity and in solicitors' hands. We are also in advanced negotiations on further assets which, if they proceed to completion, would see us fully invested on a geared basis. We will continue with the highly selective process of building our portfolio, maintaining quality, and focusing on the delivery of attractive total returns to shareholders. Further rental growth is expected, and our portfolio is well placed to capitalise. There is also the potential for further yield shift-induced capital growth during the remainder of this year. We believe that we are well placed to deal with the economic challenges that might emerge as a result of the UK's withdrawal from the EU, and that we're well placed to benefit from the positive attributes being demonstrated by our market.